In this recording, we're going to look at bonds payable. Recall, we've already gone over the idea of notes payable, and so want to look at a different kind of way of borrowing money, and that is bonds. So I want to start with looking at how bonds function in the financial marketplace. So bonds are debt instruments. So really, if you sell or issue a bond, you're borrowing money. So it gets a little confusing because they're actually sold in a public forum, just like stock. But what really happens is that instead of one debtor with one creditor, there's really multiple creditors. So let's look at how things work. Let's say in November we decide that we need to borrow some money, and we draw up these bond contracts, which are really loan agreements. So like any loan agreement, we have to state principal, rate, and time. All of that has to be documented on the loan agreement, in this case a bond. I'm going to keep it simple, just $100,000, but really if we were borrowing money through the bond market, it'd be more like $100 million. It'd be a really big chunk of money. And let's say an annual interest rate of 8%, and then 5 years is going to be the length of the bond. And here again, this is unrealistic. Usually bonds are, 10, 15, 20 years in the making. So we draw up these contracts and we lock into these terms for principal, rate, and time. Now, we don't actually borrow the money or go to the bond market to borrow money by selling the bonds until January. Well, interest rates change on a daily basis. So here's what's happening. The company issues these bond agreements where they promise to pay back, right, the $100,000 over 5 years with an annual interest payment of $8,000, right? That's $100,000 at 8% for 1 year is $8,000 annually. And in exchange, right, the company gets money based on the market price of the bond. So this is really just like borrowing, right? We sign an IOU, right? We owe money, so IOU money to the creditors. In exchange, we get money. And in the future, we pay back, right, interest and principal, just like we did with the loan at the bank. And then our debt is canceled. It's forgiven, right? It's over with. And so we can see the basic simplicity of the borrowing. It truly is a borrowing arrangement, just as if we had gone to the bank, except it's different in that here we're out issuing these bonds to a public, so there can be hundreds, thousands of creditors participating in this. The other thing is that there are going to be two variables in the marketplace. And I had just mentioned the one, and that is interest rates. So I'll just abbreviate interest with an I. So interest rates vary on a daily basis. And the other is bond prices. Bond prices fluctuate on a daily basis as well. So we have those two variables taking place. Okay, well, let's go through an example. I'm going to go through three possibilities with bonds. One is where we have the $100,000 bond and it sells at 100. That's a bond quote. That means it sells for 100% of the face value. And when I say face, I mean the face of the contract. Remember, the contract had $100,000 at 8% for 5 years. So if here's time, right, 5 years, and this company is promising to pay $8,000 a year and then a lump sum of principal, so no principal payments until the very end, and that's what will happen over 5 years. And so today, if it sells at 100, it sells at 100% of the $100,000. So it's going to sell for $100,000. And notice I've got $100,000 coming into the company and then $8,000 being paid out and $100,000 being paid out at the end. So if we were to make our journal entry on the day we borrow money, $100,000 comes in the form of cash. Bonds payable is a liability, so I'm going to credit it to cause it to go up. And so we have January 1, right, this $100,000 goes in the bonds payable account. At the end of the year then, we would have interest expense, right? So I've made, let me kind of block these off, year 1, 2, 3, 4, and 5. So when we get to this $8,000 payment, cash goes out. We want to recognize the $8,000 of interest expense. And that happens year after year after year. So $8,000 of interest expense, cash is paid out $8,000. And the accountant will create these bond amortization tables over the life of the bond. And then all the accountant does is, like, in year one, I see this 8 and that 8, and I make my journal entry. Okay, so year after year, we make these journal entries. Notice there's no entry over the 5 years to bonds payable other than this $100,000. So bonds payable stays at $100,000. So let's put that in there. At the end of each year, for 4 years, notice I said 4, so stop after you write your fourth $100,000. At the end of year 4, bonds payable still has $100,000 because we have not made any principal payments. Then, at the end of the 5th year, we're going to make a principal payment. So in year 5, in addition to paying $8,000, we're going to pay $100,000 of principal. Cash goes out, liability goes down, right? So assets go down, liabilities go down. And if we had put in $100,000 to bonds payable, now we're taking out $100,000. Now the balance is 0. Okay, the other thing I like to do is add up. Interest expense is $40,000, interest paid is $40,000. So let's look at the big picture. The company borrowed right here today, or at the beginning of all of the bond, $100,000. And in the future, they pay $40,000, right? $8,000 for 5 years is $40,000, and $100,000. They pay back $140,000. And this is just a shortcut to show you the difference between what I borrow and I pay back is interest expense. $40,000. And those are going to agree. So I could add up the interest expense, but a shortcut of solving for interest expense over the life of the bond is just to compare the difference between what we borrow and what we pay back. Okay, that's the simple scenario, and that's where it looks very much like borrowing money from a bank. But bond prices, recall I said prices and interest rates fluctuate. So here we're going to have prices go down. Well, the bond sells at 98, which means it sells at 98% of $100,000. So let's go back to the same terms. We draw up the contract in November, and we promise to pay these amounts in the future. So we lock in on that. But in January, when we go to the market, we can't get $100,000 for our bond. We can only get this $98,000. So here we're actually getting $98,000 even though we've agreed to pay this back. Well, these are not the payback terms for $98,000 at 8%, right? These are the payback terms for $100,000 at 8%. Now, we're not going to do all the calculations, but there are mathematical calculations to solve for what's the real, if I were to compute the interest rate, what's the real interest rate? And if we did those calculations, which you will do in your financial management course, but we're not in this course, we're just going to look at the generalities of this transaction, we would see we're really borrowing at 8.5%. So here's the legal form. Here's the real substance of the transaction. We're really borrowing $98,000. And to do that, that's because interest rates are 8.5%. So we're borrowing less money at a higher rate. So let's look at how did that all play out. Well, here's our formula for interest. Our interest paid, right, stays at $8,000. So in this formula, it's not a variable, it stays fixed. Time is 5 years, that's also a fixed amount. So what happened is bond prices went down. And in order to keep this in equilibrium, interest rates went up. So we see this inverse relationship between bond prices and interest rates. So prices went down, so interest rates went up. So let's look at here. The face rate was 8%, but the market rate was this 8.51%. The face amount of the contract was $100,000, but when we went to the market, $98,000. So the face rate here was less than, the face amount was greater than. And again, we have an inverse relationship between bond prices and interest rates. So again, we're not going to do the calculations for this 8.51%, but you do need to understand the general concept of if rates go up, prices go down, or just the vice versa, that they function in tandem that way. Now, in terms of accounting, how do we record this thing? Because only $98,000 of cash came in. What the accountant will do is also record bonds payable at the face amount of the bond. So the contract amount is for $100,000. Now, if we issued a bond, if we issued a $100,000 bond for only $98,000, we issued it at a discount, right? We're going to have an account called Discount on Bonds Payable. I just abbreviated Bonds Payable, BP here, and that's $2,000. So what is this going to look like? Well, this Discount on Bonds Payable is a contra liability account. And I'm going to try to squeeze over here on the balance sheet. What we would see, if I can squeeze this in on this page, is we would have bonds payable of $100,000, and then we will subtract the discount. I'm just going to abbreviate. Discount on bonds payable. It's a contra or negative liability. Okay, it's a contra or negative liability. So the net liability is $98,000. So we really sold the bond for $98,000, and we need, right, so assets go up $98,000. What we're seeing over here is there's a net increase in liabilities for $98,000 as well. We show 100 minus 2, the net increase in liabilities is $98,000. Okay, the other third possibility would be that prices go up. And in this case, I just showed us interest rates. So here again, we draw up the contract. We have these payback terms locked in November. In January, we go to the bond. This time, I had to solve for, this is present value, but let's solve for price of the bond. If we did the calculation, we would see something like $104,000 as the market price. So this time we're kind of happy. I mean, we went to issue a bond for $100,000 and the buyers gave us $104,000 for it. So we actually end up getting more money for our bonds than we anticipated. So here again, if prices go up, why was that? It's because interest rates from November to January had gone down. So because rates went down, that drove the bond price up. So really, in substance, we're buying $104,000 at roughly 7.02%. So again, the interest rates in this problem were really 7%. So we have a greater than, and we actually borrowed or sold the bond for $104,000, which is less than. So we have that inverse relationship. So here again, recording, we've got $104,000 coming in. Put the face amount in the bond. Payable account, so we just record face value in the bond, and then we need to balance it out, so we create another liability account premium. This time we actually sold the bond for more. We kind of have a premium, so that's a liability account. So on the balance sheet, when this is all said and done, we would have bonds payable of $100,000, and we would add the premium on bonds payable of $4,000. So the net liability this time is $104,000. And that's what we issued the bond for. So assets go up 104, total liabilities also go up 104,000, and we balance out. And we are not going to look at, recording bonds over the life, these interest payments of 8,000 when the bond sells at a premium or discount. That gets a little complicated. That's an upper level accounting course topic. So I won't do that for when the bond sells at a premium and discount. However, in the homework, when the bond sold at par, 100, you will have to make these journal entries for interest expense. Okay, so that goes through the whole idea of bonds payable.